What if I told you that there's a massive opportunity right now in one of the most overlooked corners of the stock market? Nobody seems to be talking about this, not yet anyway, but history tells us that when we see what we're seeing, stocks like these are setting up to make a lot of money for investors who spot the opportunity in time. Let me show you exactly what I mean. Guys, I have been investing for almost 30 years now. And what I mean by that is I've been putting the money in the stock market, but I've only been investing for about 15 years. Early on, I bought the hype. I bought what everybody talked about. I bought the stocks that were going up. I lived through that dot-com mania. I even lived through the housing crash, the Bitcoin hype, you named it, I've been through it. And I can tell you, there are 3 guarantees in life: death, taxes, and cycles. Markets will always go through cycles, but the biggest money is made when you're willing to go where others won't. That's value investing. That's principle-driven investing. Now, keep in mind, I'm not claiming to be Warren Buffett. I'm not Warren Buffett. But we, along with all other value investors, follow the same principles. We don't just talk the talk, we walk the walk. If it's popular, we immediately think it's probably overpriced. If everyone's running one way, it pays to look in the other direction. Doesn't mean you have to go there, but it pays to look. Today, we're going to talk about a setup that's eerily similar to what happened in the early 80s and after the tech wreck in the early 2000s. And it starts with a simple question: why are small cap companies so cheap? So first off, guys, small cap companies have different definitions. Some people say under 2 billion market cap, others say 5 billion. Over time, as stocks get more valuable, that number has to go higher. I basically take the idea of anything under $5 billion in market cap. That means the price of the stock times the shares outstanding. That, if it's under 5 billion, that's a small cap company. And right now, US small caps are trading at about 14 times forward earnings, compared to almost 20 times for large cap companies. That's a 30% discount. Historically, that gap is much smaller. And guys, I want to remind you, what's more likely to grow fast, a smaller company or a larger company? Clearly a smaller company. You're basically paying dollar store prices for companies that have long runway. They have a long way to grow. And it's not just random either. This kind of setup is exactly what we've seen before. Some of the best periods of small cap outperformance in history. From 79 to 83, small caps beat the S&P by, ready for this? Over 75%. From 99 to 2006, they outperformed by almost 100%. Why? Because both times, the large cap universe was bloated and overloved. Does that sound familiar? Look at today. The S&P 500 is near record valuations. The Buffett indicator, that's the stock market's market cap to GDP ratio of the US, is flashing massive overvalued at 120% overvalued. The 10-year PE ratio is even more elevated. But small caps? Well, they're pointing to potential opportunity. So guys, as you saw in the title, we're talking about this major shift happening and do this now. I want you to keep in mind, I don't know your situation. Only you do. What I'm trying to do here is teach an idea that I think makes a lot of sense. And if you're trying to sit there and look at the market in general and see where the future holds, it's pretty clear to me that the next 10 or 15 years are not going to look like the last 10 or 15 years. But there's always a bull market somewhere. There's always opportunity somewhere. So if something like this makes sense to you, I highly encourage you to do more research on it because it could be a game changer for you. What you should never do is buy something because somebody on YouTube talked about it. What you should really start doing is looking at this an opportunity for a way of thinking on your own and determining your own future and the way in which you want to think about money. The more you do that, the far more successful you'll be in it. Now let's bring in a great value investor, a very well-known value investor, a student and friend of Warren Buffett and Charlie Munger, Monish Pabrai. We interviewed him a few years ago and he's become a friend of the channel. And he is known as one of the best value investors alive today. He says that the S&P 500 is unlikely to return more than 5% annually for the next 10 or 15 years. Why? He calls it brutal math. Now guys, I actually think he's being optimistic on that 5% annually. So let me translate this. When you pay sky-high prices, your future returns get crushed. That's not an opinion, that's math. Let me do an analogy here. This iPhone, let's say it's worth $1,000. Are you gonna make a higher percent if you pay $500 for it or $1,500 for it? It's clear. You pay $500, you double up your money, you make 100%. You pay $1,500, you lose 33%. It's simple math. So if NVIDIA's trading at 30 times or 40 or 50 times earnings, what kind of growth do you need to justify that? You need a lot of growth. And guess what? The larger the company, the more elevated the price, the actual probability of that growth happening is very low. Doesn't mean it can't happen, but what it means is you should be willing to pay for more growth. You should pay that premium. But what happens with stocks is a lot of times, one thing I didn't realize 25, 30 years ago when I started, when I buy a stock, I'm buying a piece of a business. And that business has growth potential. If I pay too much for that growth, I will not make as much money. Now, Monish Prabrai points out that even Buffett is sitting on record cash levels. That is not by accident. It's because there's not a lot of value in the S&P 500 right now. But there's a ton of value in smaller companies if you're willing to look. And think about it logically. Instead of buying smaller companies, people buy these large cap ETFs and the money floods into there, driving up the prices even higher. Not right now. The market is clearly split into two camps. On one side, you've got these giant tech companies built on brand, hype, intangible assets like software. Keep in mind, they're phenomenal businesses. I do not want to discount that. On the other side, you've got smaller companies, businesses that make and sell real products in the US, and they've been completely ignored. And when something's ignored, what happens to the price? But here's what's interesting. In 2022, a mere 3 years ago, when the tech giants got hammered, small cap value stocks held steady. That's not random. That's real world performance showing up when it matters. Why? Well, when something's losing value, what are people going to do? Where can I get more value? And when they see that value in small caps, what do they start to do? They start to buy it. Now imagine what happens when interest rates start to fall again. When credit gets a little bit more loose, that means more money is flowing out there. When the economy starts rewarding companies that build all these great products again, that's when small caps shine. We're not there yet, but we're getting close. So guys, I talk a lot about valuation. And the reason being is in the short run, stocks are a voting machine. In the long run, they're a weighing machine. What that means is in the short run, stocks are going to do this. Guys, companies like NVIDIA have gone up and down 50 to 100% in a matter of 6 months. Are you telling me that a company as big as NVIDIA has really fundamentally changed its value by 50 or 100% in a matter of 6 months? Come on, there's no way. These are huge companies. These are companies that are going to be around for a very long time. That should be your indication that this fluctuation is all emotional. It's all based on short-term movement. However, what happens in the long run? In the long run, stocks are a weighing machine. Another example I love to bring is Cisco. And this is an example I'm going to use till the end of time because of how beautiful it is. Cisco was the NVIDIA of 2000. All-time high, $82 a share back in 2000, has not been met since. But you know what's interesting? Revenue and profit are up 4 to 5 times since then. If I told you back here that Cisco's profit and revenue would be 4 or 5 times greater in 25 years, where do you think people would have thought the company stock was going to be? And you know what's funny? It's selling for a reasonable price today. But here's what's interesting. Take out this short-term price movement right here, and what do you got? Got a pretty stable, good-looking graph right here. Why? From here to here, 10x price, 10x profit from before the dot-com bubble. That's what's amazing here. So if you pay the wrong price for a company, even if it's growing, valuation matters. If you pay the right price, valuation matters in the long run. But we don't know what's going to happen in between on a short-term basis. And guess what? If you're an investor, you should not care. So the question is, what do you actually do about this? Guys, I'm a big believer in dollar cost averaging into low cost ETFs, and I will never, ever speak ill about that. But what I will say is that in history, when we go sideways on large cap stocks for a long period of time, smaller companies do better. And I'm not telling you what to do with your money. I would never tell you what to do with your money. All I'm saying is diversify. If the S&P is bloated and the math is against you, maybe you start to add a small cap ETF. 3 of them might be Vanguard Small Cap ETF, ticker symbol VB. This tracks the US small cap index. It's over 1,400 small cap names. Historical 10-year return, about 10% a year. Not bad. Then there's SPSM. This is the S&P 600, which is the small cap index for the S&P. Expense ratio of 0.03%. And again, it filters through 600 small cap companies. It's more selective than the Russell 2000, has a shorter history, but strong recent returns. And of course, IWM, the Russell 2000 ETF. Expense ratio is a little bit higher, almost 0.2%, but it tracks the Russell 2000 index. It has more speculative names, but greater upside if small caps rotate back into favor. Let me be clear and let me repeat myself. This is not what I consider to be replacement. This is just looking at history and saying when large cap stocks are overpriced, they will go sideways for a while. But small cap stocks will tend to outperform at that point. It might be an opportunity to cycle into some of that money. Now, do you feel comfortable with it? I don't know. That's your decision. But I always encourage ETFs as a way, if you don't feel comfortable, to get some diversification in there. Actually, a lot of diversification. 2,000 stocks, 1,400 stocks, and 600 stocks are in those three ETFs. And I'm sure there's a lot of overlap in there. But what's very key here is you've got to remember how important dollar cost averaging is. It's so important to be able to get into assets. And remember, if it's a large cap stock, if you're looking at large caps and the stock market for large caps go like this, dollar cost averaging is still going to do well for you because you're going to buy all along the way. And guess what? It's actually not going to level out here. It probably goes like that. And you're going to pay this average. So don't stop doing that. And if you're a little bit more advanced investor and you want to buy individual stocks, this gives you an opportunity to sit there and pick the great names, find the right price, and wait for those prices to hit. Once you're able to do that, you're able to tackle everything the way I am. The way I tackle things is I buy individual stocks and I buy ETFs. I buy ETFs every month, even if I'm not buying stocks. And when I do buy stocks, I add the stocks into there. That's what works for me and my mentality. And that's why I have 4 or 5 ETFs and why I have 25 or 30 stocks. But everybody's built different. My goals are different than your goals. That's why you got to understand that. But overall, if you have a long period of time you're looking and you want to sit there and get some outsized returns, I do believe that small caps over the next 10 or 15 years will outperform large cap stocks. Now, if you're new to investing completely and you're just trying to understand dollar cost averaging and how beneficial it is, I've got an absolutely free PDF for you to download where it'll explain dollar cost averaging in more detail. Click the link below. In a matter of a minute or two, you will have that free PDF in your inbox ready for you to read. And what's important here is don't just get it in your inbox and keep it there. Read it. Pull it up. Set a reminder in your phone to read it once a month. This is what successful investing is about. It's about keeping your mindset the same direction, the right direction. Guys, I do this every single day. I run my retirement calculators every single day to remind myself, Paul, you don't need to hit grand slams. If you just get singles, you're going to do quite well. Now, I think the shift to smaller cap stocks is extremely interesting. It has been getting some attention lately, but so have the large cap stocks. They've made a monster rebound since April 8th of this year. But the reason it doesn't worry me is I'm a big believer in what I've created, which is principle-driven investing. I look at price versus value, and I want to buy individual companies when price is below value and certain ETFs when price is below value. That's what's really important here. That right mindset is what's going to make you a ton of money, but more importantly, help you sleep better at night so you're not worried about being able to retire. And one of the most important things in investing is the price you pay for what you get. And right now, the stock market, valuations are a major problem because the stock market isn't just high in terms of price, it's high in terms of price to value. Prices are soaring far beyond value, and that's the exact moment when most people get burned. In the next video, I'm going to show you why separating price from value is one of the most important investing skills you can learn and why it can make or break your returns over the next decade. So click the video on your screen now and let's get to it. Thank you for your time.